Hello, I'm Carey Cooley.
And I'm Brent Kerwecker.
Clients, it's hard to believe it's already April and it's time for our first quarter financial update.
Before we review the market performance, we do want to make you aware of the road construction that is taking place on East Main Avenue directly in front of our building. The city's in the process of replacing the sidewalks and the street, so if you're coming to pay us a visit over the next several weeks, we recommend parking behind our building and using the rear entrance. So Carey, how did the markets perform in the first quarter?
It's been a great start to the new year, with markets continuing their bull run, setting new market highs. The three major indexes finished the quarter as follows. The Dow Jones was up 5.6%. The S&P 500 was up 10.8%. And the NASDAQ was up a whopping 10.9% for the first quarter. U.S. Aggregate Bond Index was down 0.85%.
Now, the themes that drove market performance in the first quarter continue to center around inflation, the Fed, the housing market, good corporate earnings, and the labor market.
After the most recent inflation report, economic data suggests that inflation might be stickier than previously hoped, adding worries that the Fed might not begin its rate cutting until much later this year. Brent, why are interest rates so important to the stock market?
Yeah, there are several reasons for this, but the most fundamental one is that rate cuts promote broad economic growth and corporate profits. As interest rates decrease, borrowing costs for businesses decrease, increasing profitability, which tends to push both stock prices and bond values higher.
The Fed stated in the April meeting that they will not be cutting rates until they gain greater confidence that inflation is on a steady path towards 2%.
If the Fed does not cut rates by July, we believe they'll likely wait until December after the election results are known, so they're not seen as helping one political party over the other. At this point, we believe all signs are pointing to no interest rate cuts until December.
The three main areas we see for potential risk in the markets are: 1. Inflation proving to be stickier than the markets expected. 2. Less consumer spending than expected would impact the ability to continue to experience economic growth. And 3, the potential issue for worsening global conflicts.
By any measure, this was a fantastic quarter. The markets and economy continue to show resiliency in the face of somewhat sticky inflation and elevated interest rates. We continue to hold optimism that 2024 will be another positive year for the financial markets.
Thank you for watching this month's video. Please hit the subscribe and like buttons to receive future updates. And if you're curious to know if there is a best day of the year to retire, follow us on Facebook to find the answer.
Have a great week, everyone.